First rates, I'll mark the Sensex and the Nifty, the breadth of the market, and then go to newsmakers. You want to start with Paytm, and no prizes for guessing where Paytm would be. The circuit limit has changed to 10%, by the way, from 20. So 10% down 50%, आधा हो गया. 48 rupees, another 48 rupees down. Now let's look at SBI, Tata Motors, Indigo, and UPL. SBI 645, no large price action there. Tata Motors not as high as what pre-open rates were, but a 38 rupees after 100% run up, that makes it more than 100% up in last 1 year. Indigo is flying. 90 rupees higher for Indigo, a century there in terms of the price action. And UPL, not a scary start, but a subdued start. It's not 10% down, but the commentary in a sense is so subdued that I doubt that because of the mountain of debt and because of poor visibility of cash flow, buyers will come back in a hurry. So markets are reacting to news, some here, some there. The reaction is not very sharp, but for Paytm, I mean, there is just no respect.
Yeah, absolutely. In fact, it's been clocking all the selling limits on a daily basis pretty much. I think the first 2 days it was down 20%. Now that the circuit filters have changed to 10%, it's down 10% as well. Although while SBI is not down as much as one would have thought, it's still down about 1.5%. So that opening downtick is seeing a further sell-off now coming in. So I don't think the reaction is quite done with. Let's wait it out and see, because it seems that there's more by way of weakness to go. And by the way, it's not just SBI. What I can see is red ticks pretty much across the major banking pack as well. Look at the private banks. ICICI Bank down 0.5%. HDFC Bank down another 0.5%. There's indices as well, which is lower in trade right now. And some of those energy names which were actually giving us support both Thursday, Friday, Reliance are seeing a bit of a red tick come in. While of course there's all green for Tata Motors, Interglobe Aviation, LIC Housing Finance as well came out with its numbers which were above the market estimates. Moil numbers were good. Delivery, they managed to post the highest ever revenue as well as EBITDA. The revenue has seen an uptick of about 20%, but the stock is lower as we speak right now. Titagarh Rail as well came out with its numbers. The net profits have doubled on a year-on-year basis, almost touching 75 crore rupees versus a comparable of 32.6, 1.25% higher for Titagarh as we speak right now. Look at Oro Pharma. US FDA has issued 9 observations for its Unit 4 of Eugia Pharma, and that stock is taking quite a bit of whack, 4.25% lower to start off trade with as we speak right now. The index though is flat. I wonder what really is holding the index and what is contributing. Kunal, a large chunk of the index movers and large caps are in the red.
Yeah, but I think large cap names like Tata Motors, etc., I think these are the ones which are aiding to the move on the upside. Even Sun Pharma and many of the other pharma names are also doing pretty well for themselves. In terms of the opening trade, Tata Motors is something which I've been bullish on and would continue to hold the bullish stance for the stock. My near-term targets, which I mentioned in the morning, is closer to 950, but wouldn't be surprised if the stock heads slowly and steadily towards the 4-digit mark also.
All right, Naresh, let's get in your take then. How are you reading into the initial trades on D Street? What's the first trade you're punching in?
So, not a bad opening given that we've seen a downtick on the banking space as such. The stock I would continue to like is Naukri Info, which could see a breakout move going forward.
Okay, let's just see where else some of the rates are coming in. While of course Paytm is gapped down, we'll just wait by and have those F&O rates trickle in just a bit. But it's the big exclusive from one of the most respected market veterans on Dalal Street. Over the weekend, Nikunj caught up with Ramesh Damani, who discusses the roaring bull market in India and whether or not it's reaching any sort of bubble zone.
We are standing outside Bombay Stock Exchange, oldest stock exchange in Asia, which has seen many booms and many busts. But one thing has remained really common is the ability for Indian capital market to really stand tall. So what makes Indian stock market so unique? And given that we are in a vibrant bull market, what is the way forward for Indian stock market. And to really take that forward, it's my honor and my pleasure to bring on board someone who everyone loves. I have learned from, he's an original thinker and his word is always his bond, and I can vouch for it because every time we've requested him for time, well, he's always respected that despite his busy schedule. Thank you so very much for joining us.
Welcome, Nikunj. Welcome to the BSE, and thank you so much for having me on your new show.
Thank you very much. What's the first thing that comes to your mind? I mean, I can see your expressions are like a child in a candy store when I talk about BSE.
You know, Nikunj, it's such a historic area that actually gives me goosebumps to come here. If you just stand, this is like the epicenter of the Indian financial system. If you just stand here, you look north, you have SBI and RBI. You look east, westward, you have the House of Tatas, the House of Godrej is there. You go eastwards, you have the Indian hotels and the fabulous Colaba. You go back Bay Reclamations, where Hindustan Lever has its office, HDFC has its office. So we're right at the center of the financial revolution that's taken place in India. When I came in 87, 88, India was a backwater. The last street was the backwater in global financial markets. Today we are the third largest economy, headed towards the third largest economy, and the place to be. All eyes are on the last street. So it's been a lovely journey, and thank you so much for showcasing it.
So we look here, there is SBI, we look there is the House of Tatas, but if I look up, there is the House of Damani, your office is there.
Thank you, that is my old office, I did share it. And I must remind you, Nikunj, that to many people say that, you know, the village is your globe, but Paris is my hometown, to imitate Gertrude Stein. But the same way, I mean, I might have traveled the village, but Bombay is our hometown. And this building, this iconic BSE 25-story building, is the Eiffel Tower for investors. Because everyone who's come to make your money, from Dhirubhai Ambani to Narayan Murthy, you know, the streets maybe look like they're paved with asphalt, but actually they're paved with gold. And the rise of the Sensex perhaps redoubles my effort to say that. Because when I came, the Sensex was maybe 1,000, below 1,000. It's now closer to 75,000.
These the intraday swings are 1,000.
Intraday is 1,000. I mean, extraordinary journey. Some of the big corporations have gone from a few thousand crores to a couple of lakhs. And it all started in 91 day when Manmohan Singh presented his dream budget to Parliament. And that broke the ethos of static, regulated, slow growth economy to fast growth modern economy. So it's been an extraordinary journey for the last 30 years.
What makes Indian stock market so unique and so resilient?
Well, I think, let me tell you a bit of history which people may not remember. My father was in the stock market and he's lived through very painful times, the Dividend Control Act, the China war when the markets were closed and there was no foreign investment coming into India. So they were non-existent out there. Then in 1977, the winds of change swept India. The Congress government was thrown out and a new Janta government came into power. And the industry minister used to be an old socialist called Mr. George Fernandes. And here's where we learned the law of unintended consequences. Because what George Fernandes did was he told the MNCs in India at that time that either you dilute your shareholding below 40% or you get out and leave the country. So companies like IBM and Coke left India because they didn't want to dilute their shareholding. But companies like Colgate, Nestle, Hindustan Lever stayed on in India and gave shares to the public. And as history will record, the shares have gone on to become multi-baggers, 100x, 1000x, 2000x over a period of time. But they also gave India a good corporate governance. People understood how good companies behave, how good companies are managed. So we were 20, 30 years ahead of China in good corporate governance. And that is now reflecting in the markets because we have such a nice group of globally. While China, even the best companies are now trading at 20, 30-year lows. So I think that the law of unintended consequences took place because you had Mr. Fernandes throwing the companies out because he didn't like foreign capitalists. But that, in fact, led to better corporate governance and a better pool of investable companies for India.
Mr. Damani, the financial market economy right now, which is the market cap of Indian companies, is actually higher than the real economy. And that is a clear indication of the migration of economy, like Amrit Kal for financial investors. Why is that happening?
Well, you know, I'm not sure there's any particular reason, but, you know, we are going through a bull market. As Homik Haras points out in his new book about the global middle class, he says the global middle class started with, you know, a few 100 million people in Victorian England. And now I think by 2030 there'll be 5 billion people in the middle class. And I think the next billion people are more likely to come from India than China in the middle class. So the middle class demands financialization of savings, better education, action on climate change, so many things. So it's the middle class bull market that is leading it. And every bull market has its own thesis. For example, you recall when we first met in 2000, there was a big bull market in TMT stocks. It was presaging the age of the internet and presaging the age of zero communication costs. And you know what happened to those stocks at that time. And after that time, the bad ones got weeded out, the good ones continue to perform. I think what we're experiencing now, perhaps, is this great middle class revolution. I think this bull market we call the middle class bull market in India. I think that will create prosperity, wealth of a dimension that we're not yet familiar with. Another big city which is as buzzing and as exciting as Bombay happens to be Tokyo. And if you remember 1964, India won the Olympic gold medal in the Tokyo Olympics. But that time Japan was a beaten third world country. Over the next 30 years, the Nikkei went from 1,000 to 40,000. Companies that were not well known outside like Sony, Honda, Hitachi have now become well known companies. So the India bulls, which include me by the way, Nikunj, believes that India is on a similar trajectory. That over the next 25 years, as Japan went from a third world country to a first world country, Indian economy will go from a third world country to perhaps the third largest. So we are very hopeful.
We're using the word Amrit Kal. The meaning of Amrit Kal is something which is long and something which is for eternity. Do you think India's indeed Amrit Kal has started, and especially for financial investors?
I think it has, because it's hard to. I think the Sensex moved at 15-16% compounded. The last few years probably better than that, with dividends about 18%. It's an extraordinary return, even if it's in rupees and not in dollars. It's an extraordinary return, and there have been very fair and just tax policies, the government. And more importantly, I think this bull market, you have to give a lot of kudos to the Prime Minister's office, the Prime Minister and DIPAM for the way they've handled the biggest investment Indian taxpayers have made, which is in the public sector stocks. By introducing better corporate governance, by stopping leakages, they've really extracted value from these companies, which was sad and forgotten in the Indian stock market. So I think we owe a lot of credit to the government for its forward-looking policies on that matter. So having said that, if these companies can start delivering a market rate of return, Amrit Kal should not be too far behind.
So since we are talking about Mumbai, and the last train station is in Mumbai is Churchgate. First train station.
Yes.
I mean, from people coming from there actually. But yeah, the first train station, if you live in South Bombay, is actually Churchgate, and it goes all the way to Kandivali and beyond. So if the Indian bull market is a train journey, starting from Churchgate to suburbs of Bombay, where do you think this train journey has reached?
It's a very interesting question. A lot of people think, for example, that we're in a bubble sort of atmosphere. I don't think we're in a bubble. All bull markets end, Nikunj. That is the tough news. No bull market rise permanently. Even this bull market will end. But having said that, we are not seeing any indications right now of the bull market ending. I'll give you an example earlier when I said the Japanese bull market went up 40x in yen terms and 100x in terms of dollar terms. So bull markets can go on for a long time, and they change the complexion of the country. And I believe we are in such a bull market. I think when we get closer to the top, there will be flashing signals of red. I don't see that right now, so
what
I'm
are
going to
those
enjoy
signals?
it. Signals are, when the way market reacts to news, it won't react to good news, it'll react to bad news. There'll be extreme amount of leverage, extreme amount of IPOs coming to the market, a lot of idiotic talk going on Dalal Street. What we are having now is more of a rolling sector-wise correction. So markets gets overheated in large caps, it will correct. Markets overheated in some other stocks, it will correct. But the underlying tone is good because liquidity is good, domestic money is good out there. Market still reacting positively to the announcement, and market very hopeful that the election outcome will be a market-friendly outcome.
The whole purpose of a stock market was to provide capital. Companies like Infosys, they've come and they've tapped capital from here. But today, the innovative companies are not coming to stock market. They are coming to stock market after they reach a size. So do you think the role of stock market going forward could diminish?
I don't know, I've heard that, but I'm not really sure. I hope not. It's been a great place, and our trading systems are now the best in the world. We do T+1, we might go to T+0. It's extraordinary the amount of risk and volatility we have subdued. In 90s, when I used to walk the street of Dalal Street, you'd always fear there'd be a default coming and the markets would be closed and deliveries won't happen on time. I think that fear has been completely removed by the forward-looking regulations of the Securities and Exchange Board of India. So we're deeply grateful to that. So I think the stock exchange will remain a capitalistic outpost, and this will be our Eiffel Tower.
To really look at a very simple way of how Ramesh Damani invests, you've always said that, look, I'm not going to give you a fish to eat, I will tell you how to catch a fish. So no tips, no advice, but the framework. Share your framework with us. You always say buy something which is cheap, buy something which is long term. How does it work?
When we were young, we used to play the game of passing the pillow. And I think a lot of people who come to Dalal Street, the new ones and the younger investors and the more ones who are excitable, tend to pass the pillow. They buy something at 80, goes to 85, they sell it and they're very happy. They go out, have a drink, celebrate, whatever. But the true winner in this game is the one who holds the pillow at the end when the music stops. And that music is not going to stop for a while. So you invest in great companies and give them a chance to grow. I've seen so many companies, Nikunj, that seem to have peaked out, then they correct maybe 30%, 35% after time, then they come back and make new highs. You know, good examples are companies like ITC, for example, or Lever or Reliance, which have conquered many a bull market and gone on to new highs. I think there are extraordinary amount of companies available in India with good corporate governance, good fundamentals, that will temporarily peak because of valuation go down. But the true winner making long-term wealth, and stock market is about making long-term generational wealth, will be the ones who hold on to that pillow to the end. I think, you know, you can imagine what a financial conglomerate in America is worth and what it's worth in India, what a tech company is worth in America and work in India. I think if you start doing those numbers, you tend to be more patient and hold. So my advice, to come back to your question, to all new investors coming, is that if you have to trade, trade, but only trade with a portion of your money. The rest, invest in a great business and believe in that business, hold on to it. Think you're not buying a stock or a price movement, but a piece of the business, and you want to hold that business. And the true wealth is sometimes created there.
You've always said that the definition of a good business is that it should serve a purpose. It should solve a problem, it should be scalable, and it should be run by good guys. So which are some of the businesses you think are built to last business? One of the lovely books you've shared with me, Built to Last. Let's apply that in real life.
Yeah, I think clearly you want cash flow. And the way the capitalistic cycle works is that all business go bad after a period of time. You remember Eastman Kodak. The market for photography has exploded. Yet Kodak, which is the most well-recognized brand name in photography, has imploded. It's no longer even traded out there. They didn't see the change coming. So people who think of themselves very narrowly perhaps tend to get, defocused. So you don't think of yourself as being in the railroad business or the airline business, but in the transportation business. You don't think of yourself being in the movie business or the television business, but think of yourself as in the entertainment business. So you want to find businesses that have a broad application and have good cash flows to support the yield. And you buy them cheap. I think one of the big myths about this bull market that started was that a lot of people started espousing the theory that we only buy quality and we only buy quality at any price. That's a big myth out there because, everything has a price. Especially the market is known to weigh a price for everything. So you obviously want to buy a great quality business, but when it's available at an attractive price. So the stock market is a great discounting mechanism. It discounts everything at a price. And you find a bargain, you can get on and step onto it. So don't make that mistake of saying I only want, to give you an example, companies as the quality of Lever and Infosys did not give returns for 10 years to investors because if you bought them at the wrong price. So buy it at the good price. So a good business at a great price held will almost certainly make you money.
Why do stock markets follow a cycle? There was a time, which was a couple of years ago, quality at any price. It really worked. Now PSUs have made a comeback. There was a time when TMT did rather well. There was a time when real estate stocks were doing very well. Why does it happen?
It's the nature of the business. It's the nature of the beast, if you will. One thing I always try to explain to people is distinguish between risk and volatility. Risk is the chance of you permanently losing capital, and you can't afford to do that. Volatility is the nature of the beast. As you said, we were down 1,000 points the other day. It seems like a lot, 1,000 points. Oh my God, what's happening out here? And think of the other way around. If you had told me when COVID started, the next 4 years there'd be 2 wars going on globally. COVID would ravage all the continents. India would go through its own cycle of so many problems. You wouldn't have taken the bet that India would be 3x up. But the fact is the index is 3 up. So market rewards the patient investor, the good investor, and businesses find a way to be resilient and come back. And I think that's what they're doing. I think this is, of course, a multitude threads in this, but one of the threads, of course, is the great growth of the middle class that I told you, that is powering up. So I think Buffett often talks about what he called the ovarian lottery, that he was lucky that he was born to white parents in America. I think this generation of Indians should feel very lucky that we're at the right place at the right time.
So I have to take the clock really forward here. We're in 2024, let's say in 2040. Dalal Street would be there. I'm sure we'll be interacting with you. What kind of India do you emphasize? Because with each cycle, the market cap construct of the market changes. What was blue chip, that's no longer the blue chip. What was blue chip in 1995 is no longer the blue chip of 2020. How do you see the construct of the market changing in next 10 years?
Well, it's very difficult. I mean, every bull market provides its leadership, like I said. So I told you, this bull markets, let's say with the public sector stocks, with the consumption theme, with the BPO people. We don't know what the next bull market, I cannot foresee what the next bull market would, but there's one thing I do believe, that the capitalist system translates or transmits between fear and greed, that people are going to be afraid to buy stocks and people are going to be rushing to buy stocks. Okay? And when they're fearful, we want to be stepping up to the plate and buying and putting our capital to work, because at the end we have a deep belief in the abiding nature of capitalism in India. And when people are very hopeful and extraordinary jumping over to buy stocks, probably we'll book some profits out there. But I often say that the 3 Ds that are powering India are what I call democracy, demographics and digitization. India is a young country. While China is going to lose 400 million of its population by the year, next 20-25 years, India is going to gain 400 million. That is equivalent of creating a US or Europe in India. So demographics, India is in a sweet spot, young country, age below 30. So demographics is almost destiny in economics, as they say. So that will happen. Democracy, I mean, America is still litigating the 2016 election, or some say even the 2000 election. Who won it? Was it Bush or was it Gore? Who won Florida? They don't know. And in India, we have elections, results come in 12 hours, people accept the results and we move on out of that. So I think democracy is enshrined in India. I think people are now seeing the advantage of that. When you go to a capitalistic system, you can have major companies like Alibaba, one day by the wrath of a bureaucrat, completely assigned to the dustbin. Whereas in India, the democracy is slower, but it's more jurisprudence going on out there. So that is always good out there. And so you put democracy, demographics, digitization. You know, when Neil Armstrong came to the moon and I was a young kid of 12 years old, he said this is a small step for man, but a huge leap for mankind. I think digitization is India's huge leap. What has happened is allowed us to transform a chronically under infrastructure country to a beautiful infrastructure, because it relies on digital this thing. So whether it's UPI, Aadhaar, biometrics, and Nagpur, as you say. And that's an extraordinary revolution. They're getting good paid jobs. America just reported 3.5% unemployment rate. They don't have people at $20 an hour minimum wage. Here you can pay them $20 probably a day and probably less than that, and get a very high quality workforce. Cost of telecommunications is zero. Cost of office space is pretty attractive in India. So this business will boom in India. So I think the third leg of this 3-legged stool, democracy, demographics and digitization, is what's propelling this long-term story out of India.
There's another D, the Damani effect.
You're too kind to me.
Tell us a story which you've not told anybody about Dalal Street, about your experience every time you would walk from here to your office.
You know, I think on a more somber note rather than a more exciting note, I think one of the hardest days was, I think in '93, when there was a bomb blast that ripped through BSE, and these were the streets. You know, you could walk through. A lot of my vendors that I knew and a few of the colleagues I knew were injured on that day. It was heartbreaking. But there's good and bad time to story. The good part is the resilience. The market didn't even close, it opened as soon as possible. I think Sharad Pawar was the chief minister and he made sure that the BSE opened. He realized the importance of the BSE as a resilient factor in that day. And the BSE, I don't even think took a break. They opened, I think it happened on a Friday, they opened on a Monday for regular trading hours amidst very high security, but they did open. But also this building was constructed by a company called Larsen, you know, and it withstood the impact because the institution created to withstand impacts, not only economics, but also in this case a bomb impact, you know. And the market, you know, the building survived, you know, everyone was safe in the ring. Imagine that bomb had pierced through the trading ring. The entire generation of Indian financial leaders would have had a 9/11 on their hands. You know, we all survived because of the construction of genius of some Indian companies. So we are truly grateful for that.
So when it comes to Mumbai, it's financial markets, it's Bollywood, it is food, and it is real estate. What else comes to your mind? Because you're a Mumbaikar.
I'll tell you about food though. I'll tell you a story which you said something nobody knows about here. We just walked down this lane a little bit. There's a Udupi restaurant called Purnima.
Yes.
And if rumors...
I went there in the morning actually, just a coincidence.
Yes. And if rumor has to be believed, well, Nikunj Dalmia eats there, Narayan Murthy is eaten there, and Nandan Nilekam, when they came for the Infosys IPO.
And even Chandra from TCS is there now.
They used to come and eat there out there. So there's a little known eatery out there. So if you come to Bombay and you enjoy good food and seeing Dalal Street, do pay a visit there.
All right, thank you very much. Thank you so much for your time and thank you so much for sharing what lovely insights. You know,
it's always a pleasure to be with you. Thank you so much and good luck on your new show.
All right, don't see quality at any price is a myth, and talking about how you're buying a piece of a business when you buy into a stock. That is Ramesh Damani for you. But let's hear it out then a little bit more from the top market experts. Why are the big voices bullish on the oil and gas space? Is it a good time to buy into some of these oil marketing players? Hear it out from none other than Vijay Kedia as well as Purinju Veliath.
मेरे को लगता है OMCs का टाइम आया, not because of the oil and all, only because of one thing I have noticed, Nikunj. Let me tell you that solar के अंदर में and this China is dominating the entire world, dominated by China, right? I think this hydrogen thing which is just started happening, so that will India may take the lead in hydrogen and all. So I think all these OMCs, including IOC and BPCL and HPCL, they are diversifying into hydrogen.
This has been one reason the stock has been underperforming for last several years. Even after having such kind of dividend yield and cash flows. But the business is going to stay after 5 years, 10 years, and 20 years. And the kind of demand is going to be there. In spite of all those alternative fuels, nobody can stop. And ONGC, one reason was it was into a declining trend of last 15 years in terms of production. I think now there are many things happening. The production is going to, I think, stop declining and start moving up.
In fact, let's take that discussion forward. What's really the future prospect of not just OMCs, but the entire energy sector? And who better than MK Surana, the former CMD at HPCL, joining in on the show right now. Mr. Surana, hi, morning. Great to have you on ET Now. And what a move coming in on OMCs as well as ONGC of late. But given that crude has remained largely below $80 to a barrel, is it the right time for OMCs to take a price cut, and do you think they might have sort of recouped the losses incurred earlier on marketing business?
Good morning and great to be on your show. So two things, it's good to see the OMCs realizing a part of their valuation after a long time. But as far as crude is concerned, I think with all the factors factored in, which keeps on varying from time to time, I think it is a realization that the crude is somewhere in $75 to $90 range. So the time of people expecting it to cross 100 or is not being considered anymore by the people now. So there is more stability in the crude prices and more likely to be around 80 in the near future. Now, whether the OMCs should cut down their prices, I also said earlier, and I maintain that it is a longer term view they need to take, that either they continue to vary day-to-day basis consistently, or they see a bit longer term visions to ensure that the spikes are evened out and the market is more stable as far as the day-to-day pump prices are concerned. Now, in the recent past, there has been some good margins and which would have helped them to recoup a substantial part of their losses from the past, or maybe all of the losses from the past. What view they need to see is that in the coming future, whether again there are possibilities of a hike, and considering the election year, where if the prices are maintained the way they are, whether they've got a threat of any under recoveries. And based on that perception, they can take the decision to cut the prices or bring it to the day-to-day. In my opinion, cutting prices rather than whether they can bring it to day-to-day variation the way it was. That may be the more opt way of doing it.
Right. But you think the run-up recently is because of fundamental upside for OMCs, which the market is predicting, or do you think it's also a play of the fact that most of these OMCs were trading at very cheap and low valuations?
No, run-up in the OMC is a result of, I think, multiple factors. So some are structural, some are marketplace, some are the direction and the momentum. So if we see few of these factors, one thing is sure that OMCs had been undervalued and market had not been factoring in the intrinsic value of the OMCs for some time. And I think after 2018, there was a lull period in the OMCs. And what prices we are seeing is almost to the level what we had just before 2018, and is coming to that level. OMCs always had a great intrinsic value, and one more reason that many of the capital projects which these OMCs have taken in last 4 or 5 years are coming to fructification, and they will give they will add up to their bottom line and top lines. The third part is there is a lot of money which is chasing the market, and normally the favorites have already overpriced. And now the people have started looking at the other strong contenders which were not valued, and the PSUs are one such lot which was not valued according to their intrinsic value so far. Though the oil sector and the power sector had the strength, at least some companies in the power sectors, power producing companies did have their strength, and as well as the oil and gas with both upstream and downstream companies. And that is getting realized now by factoring in the value by the market. And it has also got the fine balancing which the Indian government has done, and the diplomatic front as far as the crude is concerned, whether it is the Gaza issue or whether between Israel and Hamas or whether it is Russia and Ukraine. And the India has maintained a very balanced view on this, we unequivocally stating our position to ensure that we are not subjected to the crude price constraints or the premiums, unnecessary premiums because of that. Of course, some premium will always be there depending on the global conditions. But purely the supply demand local situation, it should not get impacted. And the last part is the Indian economy is in the pinkest spot, and it is India is a destination to watch. And the whole world looks at the Indian stocks in a different light now than what they were looking. And that is what you see in some of the upcoming PSU sectors like railways and defense and all that. So I think OMCs are in a good spot. They had always been in good spot as far as the valuation is concerned. I think the market has also factored in one thing, that the green is not that green and the gray is not that gray, and the distance between the two is a bit more bridge based on.
Mrs. Rana, that's all great news, but are these companies future ready? Eventually, EV is taking over, eventually new sources of fuels are getting discovered. That could be 10 years away, 15 years away, but for companies which are in basically fossil fuel, retail, refining and distribution, the terminal value will come down. What is the future for them?
So Nikunj, if I can just take back the history, when Euros fuels were coming, everybody thought that it cannot be made in so fast and so quick time, the country cannot change over. But all the deadlines of whether BS3, BS4, BS6 were met, rather ahead of the time it was met. Similarly, people thought that 10% ethanol blending cannot be done so fast, there is no production capacities, but it was done. LNG or CNG or PNG supplies also, the efforts were taken. So the oil companies do have their own strength as far as the execution is concerned and being ready for the changes in the market, and they had been adaptable quite well. In spite of the dominant PSU structure, I think oil sector has been one such sector where the adaptability to the situation and bringing in the new things had been quite good. That is what I have seen over the period of time, as far as technology is concerned, as far as new business models are concerned, or as far as the change of the product line itself is concerned. That is how the oil companies had an integration of petrochemical, they had integration of gas, they have integration of LNG, ethanol blending, green power, and the 2G and 3G fuels in the system. And I'm sure that the actions which are being contemplated and taken even on the green hydrogen, etc., as far as technology is concerned, as far as economics is concerned, so they are quite at it. Not all becomes visible all of a sudden because market is used to see the result which comes in terms of immediately whether it is adding to the top line or bottom line. But we need to realize that the oil and gas sector is one where there is a gestation period for fructification, anything, even if you set up a refinery or petrochemical plant. And I think they are at it and they are taking and ably supported by the government policies and the push also. And therefore, I would think that I don't see a risk of these companies not being ready for the future. But what is important is we need to be clear about what should be the future, and it will be incorrect to adopt a Western model to India completely in terms of our transition is concerned. India has got their own way of looking at the energy demand, energy accessibility, support, security, and the total ecosystem and the social system. And I think it will take slightly longer, or it need to take slightly longer, and we need to follow a path which suits to our country.
It is fucking 31.
All right. I just wanted to get in your take because in the budget, the government had provided for around 12,000 crores as subsidy. Do you think that this will be sufficient given that we are seeing LPG prices rise as well as domestic prices being unchanged?
So there is nothing called sufficient as far as subsidy is concerned, or nothing is called more. So these are all the estimates which the government makes, which the oil companies make in the beginning of the years. And we need to go as it goes. Sometime it is a longer time it gets evened out. Sometimes the shorter term it gives them stress. But I think they would have done some intelligent guesswork on this to provide for the subsidy for LPG. And if the situation demands, then the appropriate actions will be taken accordingly.
All right, Ms. Sulana, appreciate your time. Always nice to have you and get your insights. Mr. R.S. Jalan, Managing Director of GHCL, joins us. Now, Mr. Jalan, good morning. Thank you for joining us. Now, performance was impacted because of weak demand trends. Help us paint the big picture because soda ash prices of late really have been very volatile.
Yes, Nikunj, good morning. You are right that if you compare our performance as compared to the same quarter last year, we are 56% down as compared to the same quarter last year. But as I have been indicating in my last few calls that last year, 22-23, was a peak period for the soda ash industry. However, now the situation has become normalized, prices has softened, and probably you will see the similar kind of a situation at least for the next few quarters. In terms of the demand, India demands are intact. Frankly, it is growing. However, globally, particularly Europe and US, since our demands are down, and therefore a lot of materials are getting imported into India. And because of that, there are a lot of imports happening in India, and that is also kind of impacting overall situation in the pricing as well as the supply or the sale of the figure. In spite of this, GSCL per se has been able to maintain the similar kind of a volume as compared to the same quarter last year. And I am sure that the way the demand we are seeing in India, we will be able to maintain the similar kind of a supply, the sale into our business.
But given that right now European prices are low, things in China are still on a mixed, are still mixed. Do you think that internationally the prices are unlikely to recover?
Yeah, Nikunj, two things very interestingly you spoke about the China. In spite of in the China, a lot of new supply has come in. In spite of that, in China, the demand is almost around 5 to 7% higher than the last year. And the prices are very firm. And this is, I think, typically first time it has happened that Chinese prices are much higher than the global pricing. And a lot of materials, European and as well as the US manufacturers are exporting to China as well. So given that scenario, and that is primarily happening because of solar and your EV batteries. Because of that, the demand is there. However, the moment this Europe demand recovers, the soda ash prices will also recover.
But the point is, when will demand recover? I mean, obviously, if demand will recover, prices will recover. The point is, when will it recover?
See, Nikunj, my understanding is that next few quarters definitely is going to be pain. Maybe 24, 25, maybe later part of 24, 25, probably you will see the recovery part happening into the European market as well as in the US market. Because Southeast Asia is also recovering, and I would say South America is also is recovering. So hopefully by next, after 2-3 quarters, the prices should start recovering.
Okay, give us just a sense as to, if you can, what would be some sort of an outlook when it comes to refining margins? Right, apologies for that. Just wanted to get in an outlook from you in terms of the soda ash prices and how you're looking at that impacting your margins, because they did fall from the recent peak of about 33% last December to about 19%, largely on the back of lower realization. So what's the outlook there?
You see, basically, in terms of the soda ash prices are likely to be softened further from here. However, because of the cost is also coming down, to my sense is the margin will remain in this level.
And by when, are you looking at some of those MOUs you recently signed, about 3,500 crores in Gujarat, roughly, for the Greenfield Soda Ash plant? How are you looking at funding your overall capex? Because as I understand, the cash surplus stands at about 625 crore rupees.
See, today the cash surplus with us, if you look at in terms of the net debt, yes, 625 crore, but cash on the balance is around 825. And like I said in the past also, globally and as well as in India, we are seeing a very robust demand in the sodas because of the solar investment where the government has. Recently, you have seen in the interim budget, the government is very aggressively pursuing the solar on the rooftop solar. So therefore, we are seeing a very good demand into the sodas, and therefore we have signed this agreement. Now we are planning for a 1 million ton on the new greenfield project. Out of that 500,000 we have signed before, and now another 500,000. So in next 3 years' time, probably the first 500,000 will come, and after that another 2 years, another 500,000 will come. In terms of the financing, as you know that we are today is the cash surplus, and we have a borrowing capacity of around 3,000 to 4,000 crore rupees in the current situation. And this investment, which will require in the next 5 years, will be generating sufficient cash with the debt and the cash, and the remaining in the same debt to equity ratio of 1:1. We will be able to fund this capex requirement.
There was a strong impetus as well on rooftop solarization as well as e-vehicles and infra housing. All of that bodes well for you. But what is the current scenario when it comes to solar gas investment, lithium ion? How are you looking to capitalize on some of those announcements?
See, two things will happen. So far as the lithium carbonate is concerned, probably in India, it will, I've said in the China, around the growth in the EV itself was around 40%. So probably the supply of Europe as well as the global will get consumed there, and therefore India will have a lesser import coming in from these global market, and that will give you a better kind of a demand scenario in India, number one. Second, the solar investments are very aggressively being pursued. As you know, many big players have announced big plans for the solar investments or the green hydrogen, and this will require the sodas. So we are seeing a very robust demand coming forward.
What happens to the input part, which is that international coal prices have also started coming down? It is something which you think, when will that start reflecting in?
Yes, Nikunj, as I said, though the prices of soda ash looks to be softer from here, but in spite of that, because of the input prices are going down, we will be able to maintain the margin at this level. And this will get reflected in our next quarter, January-March quarter. You'll see that the prices are cost also coming down. In the last quarter, Nikunj, also what has happened is that we had a kind of a shutdown, and that shutdown our cost had gone up because of the shutdown, and our production was also lower by 20,000 tons. And because of that, also the margin was impacted in third quarter.
So if you have to, let's say, talk about FY25, the new capacity would have kicked in, I'm assuming, somewhere in FY25, because you are in middle of your capacity expansion. When will that new capacity kick in?
No, Nikunj, our new capacity will not coming in 24-25 because Greenfield project will take another 2.5 to 3 years from now, and therefore that new capacity will not coming in. But yes, our production next year will be higher by around 5 to 7%. And we believe that the margin next 24-25, the margin should be in the similar range bound, what is currently which you are seeing. Because we are not saying very aggressively in the first few quarters, the prices are going up from here.
Okay, great to have you then on the show, Mr. Jalan. Thanks so much for taking the time out and speaking with us today.
Thank you.
Let me now welcome on board Arun Maheshwari, the Joint MD and CEO at JSW Infra, to talk about how their quarterly performance was. Arun, hi, morning. Your strong numbers this quarter, as per what the analyst was estimating. What reasons you think drove this strong volume reported by you?
No, it's a natural, the capacity utilization which we have created. The capexes were already done in the past, and the utilization was started happening now because these are new terminals. Especially the strong growth came in from our Paradeep iron ore and coal terminals, which are relatively new. One is 3 years old, one is 2 years old. So the utilization of the assets are started happening now. So that has led to this kind of growth.
Margins have also crossed 50% mark on a consolidated basis on cost reduction initiatives. What will be the long-term sustainable margin outlook for next 2 to 3 years?
So in a port company, typically the margins are a factor of utilization of the assets as well as the how the volumes are driving it. In our case, the volume growth has been decent enough, and that's where the percentage of EBITDA growth you can see over here. We don't see any drop in the volume in near future because the locations are such that the utilization will continue to remain very robust and going upward from here on. So the margin projections are likely to remain robust.
And can you share with us the integrations and status progress for the recent acquisitions undertaken, especially at the Mangalore port?
So there are two acquisitions which we have done in the last quarter. One is the oil tankage terminal in Middle East, Fujairah, which was the first such acquisition because we were never big into liquids. So this was one of the acquisitions which, because we have a lot of presence in that part of the world. And it is a comfort zone wherein we could put a hands-on experience on the largest oil port of the world. And we are having a very good experience. It's only a month now, but then we are really enjoying that part of it. The second acquisition which we have done is a PNP in Maharashtra, which is in Raigad district. It's a riverine port, which is a 5 million ton capacity with a 19 million ton of kind of environment clearance already available over there. We see a synergy impact over there because that port is, though small in size, but it has a railway connectivity. It has, of course, a shore side, and as well as the land available over there for future expansions. We see a very good synergy impact with Jaigarh port, which is in Ratnagiri district, about 120 nautical miles south of it. Jaigarh port doesn't have a railway connectivity as of now. With this kind of port acquisition, we see a lot of synergy happening, especially when the government is coming with the RSR kind of project, Rail Sea Rail, what they call as. The movement, coastal movement has been, is being encouraged quite a lot. We have a coal terminal in Paradeep. So a lot of cargo generation from Paradeep is likely to come to PNP port. Part of will come via Jaigarh with the hub and spoke model, which has been our flair for the last couple of years. So this will have an overall synergy impact. The coal is moving from east coast of India to west coast. A large port is Jaigarh, wherein it get tranship, come to the PNP port, and thereafter it can take a rail route to deliver into central land or hinterland of Nasik, Manmad, Bhusawal, Belgaum, all these places.
Right. Your recent announcements in the interim budget on port connectivity, even for Middle Eastern Economic Corridor, has also come through. What kind of growth are you looking at for the port industry, and by what rate can the industry then grow?
See, the government has been very clear for the last 4 or 5 budget, if I have to analyze very clearly. They have been very, very focused on reducing the logistics cost for the country, because this is the cost which is going down the drain because of inefficiencies. So a lot of spend has been happening on the infrastructure side. This is the first time wherein we could see a signal wherein the government has done good enough and they are looking forward towards the private sector to invest more and more into this sector. And the companies like us, which are very solid balance sheet, we would like to, encash upon this opportunity. Having said that, we also look at the kind of thrust is given to the coastal movement by the government. The port-led connectivity projects are the top of the deck for them. They really want the country to come up with the investments in the projects which are going to create a complete massive infrastructure for movement of cargo east, west, north, south, everywhere, whether it's by rail or by sea or by pipelines, or by road. So I think overall this industry is looking very, very robust. If a country has to go from 5 or 7 trillion economy to 10 trillion economy, it cannot happen without touching the shores. It has to shake the shores. And India has a large coastline, good opportunity, a play for everyone else to get into it. So we see this is a very, very good opportunity for the port sector. The growth has been 3 to 4% over the last 10, 15 years of CAGR, if I have to look at it. But private player growth has been much faster than government, because government has 12 major ports. They remain there. Of course, the capacity increase is happening on those ports because of mechanization and modernization. But the private players are really coming up very, very big on this sector.
In the Red Sea have disrupted trade globally. Any kind of impact that has been felt by the company? Has the backlog cargo started piling up for the third-party customers?
No, if I have to look at the port sector per se in which we are operating as of today, because our port sector is in our entire portfolio, oil and containers are not as prominent today as what in general where the disruptions are happening. Ours is a largely industrial-based kind of handling. These are bulk process-driven industries, be it steel, be it power, be it mines. So we don't see those disruptions impacting us, be it a Red Sea conflict or be it conflict in the Ukraine area. It has really not impacted us anywhere, any which ways, because most of our cargoes are coming from Australia, Canada. If it is coming from US or so it takes the South Africa route and bypassing the Red Sea channel. So we don't see that kind of any kind of disruption in our business.
Appreciate your time. Thank you so much for joining in on ET Now. We'll take a very quick break. Don't go anywhere. The corporate voices continue on the channel.